Today, danger, bank fragility ahead. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news with a distinctively Australian flavour. And this is our last weekly review before we head off to the UK. So the question we are facing today is, are we in the foothills of the next banking crisis? Well, actually, quite possibly. Investor sentiment remained fragile on Friday despite massive rescue operations for the banking sector, leaving global equities under pressure, while gold prices were poised for their largest one-week rally since March 2020. The US banking crisis began after two mid-sized lenders, Silicon Valley Bank and Signature Bank, were rescued by the Federal Deposit Insurance Corp last week, as depositors yanked billions of dollars from them after fearing their insolvency. Silicon Valley eventually filed for bankruptcy protection over the past 24 hours, and the third bank, First Republic, is also in trouble despite receiving a $30 billion cash infusion from a consortium of banks. SVB Financial Group announced it would seek Chapter 11 bankruptcy protection. That's the latest development in an ongoing drama that began last week with the collapse of Silicon and Signature banks, which sparked fears of contagion throughout the global banking system. On Friday, investors lost confidence in US regional banks and Credit Suisse in Europe, and risk appetite waned after showing some signs of recovery on Thursday. Credit Suisse's chief executive said on Friday the bank was working hard to stem customer outflows, although this could take some time. Credit Suisse shares resumed their decline. Analysts say the worry about a possible banking crisis is far from over, despite a group of major banks injecting $30 billion in deposits into First Republic Bank, that's a mid-sized US lender, on Thursday. First Republic Bank stayed off a potential collapse after a group of bigger financial firms agreed to park a combined $30 billion in deposits with the lender, but the cash injection is really only a short-term solution, and investors are unsatisfied. The San Francisco-based company will still need to move quickly to find a way to remain independent or strike a deal for a takeover. The deal with the 11 lenders include Bank of America, JP Morgan Chase, Citigroup, and Wells Fargo, includes deposits with an initial term of 120 days. Disclosures made by First Republic regarding this latest liquidity injection remove all doubt that a significant runoff of deposits has occurred, Morningstar said. So the market may be interpreting that the $30 billion of new deposits that's going in will stave off a depositor run, but it hasn't added any new liquidity to the bank, Arthur Wilmarth, Professor Emeritus at George Washington University's Law School, said. The shareholders know that they are certainly a risk. First Republic shares slumped anew on Friday. They were down 26.8% to $25.08, and they've plummeted 79% this year. Friday's stock plunge underscores the tenuous situation for US policymakers. If the bank's rescue ultimately succeeds in easing worries about the sector, Washington will have avoided fierce political blowback that certainly would have followed any government intervention. But if it doesn't ultimately calm broader concerns, officials face a series of tough choices on the next steps. And as the market's worries is the fact that First Republic tapped a Federal Reserve liquidity line around $109 billion in the days leading up to its rescue by the big banks, said Arnold Kokuga, a bank analyst at Bloomberg. First Republic has been exploring strategic options, including a sale. So maybe this $30 billion in deposits from big banks only buys time, but concerns remain. Analysts have been forced to extrapolate from data that First Republic provided to determine exactly how its financial position has changed in the past few days. One estimate from Jefferies Financial Group pegs potential deposit outflows at around $89 billion. The bank said in a statement late on Thursday that insured deposits remain stable between the close of business on March the 8th and 15th. Daily deposit outflows have slowed considerably, they said. According to a December filing, the bank had roughly $119 billion in uninsured deposits at the end of last year, a little more than 67% of its $176 billion in total deposits. Meanwhile, analysts have been cutting their recommendations on the bank. Wedbush lowered First Republic to neutral, saying it's difficult to come up with a realistic scenario where there's residual value for FRC common equity holders in the event of a sale. A Morningstar strategist, Eric Compton, said that while the $30 billion of deposits appeared positive on the surface, it also confirmed some of the people's worst fears about the financial health of the bank. Prior to this event, we did not know for sure if First Republic had indeed experienced a true run on the bank, or that perhaps the bank would be able to maintain its deposit base relatively intact. Disclosures made by First Republic regarding this latest liquidity injection removed all doubts that a significant runoff of deposits has indeed occurred. Evercore analyst led by John Pacari says that the deposit infusion allows the bank to fight another day, but that's it. It's a temporary solution, particularly given the noted 120-day window. First Republic specializes in private banking and has built up a wealth management franchise with some $271 billion in assets. Those watching the company's travails say that helps to make it a potentially attractive takeover target. They never were a traditional bank, said John Allison, the former head of BB&T Corp, a predecessor company to Truist Financial. They are in a very good market and they have a very good market share. They were after the high income deposits. The negative to that is that they're uninsured. So First Republic Bank plunged 32.8% after the bank announced that it was suspending its dividend, reversing Thursday's surge, which was sparked by that unprecedented $30 billion rescue package from large financial institutions. Among First Republic's peers, PacWest Bancorp fell 19%, while Western Alliance slid 15.1%, and the US shares of Credit Suisse also closed sharply lower, down 6.9%. And overall, the Dow Jones Industrial Average was down 1.19% to 31,858. The S&P 500 lost 1.1% to 3,916, and the Nasdaq slid 0.74% to 11,630. Over the last 2 weeks, the S&P Banking Index and the KBW Regional Banking Index plunged by 4.6 and 5.4% respectively. That's the largest 2-week drop since March 2020. And the yield on benchmark 10-year Treasury notes fell to 3.428% versus 3.583% previously. And the 2-year yield, which rises with traders' expectations of higher Fed fund rates, fell to 3.8358 from a previous close of 4.13. So now markets are pricing in the 25 basis point increase by the US Federal Reserve when it meets next week. That's down from the previous expectations for a 50 basis point increase. And at last glance, financial markets had priced in a 60.5% likelihood that the central bank will raise its key target rate by 25 basis points. But there's a 39.5% probability that it will let the current rate stand. Fed data on Thursday showed that banks sought record amounts of emergency liquidity in recent days, which helped undo months of central bank effort to shrink the size of its balance sheet. Its latest discount window borrowing has seen banks take out $150 billion more, which makes for a new record, even topping the 2008 global financial crisis. The fact that the Fed has been very proactive in terms of opening the liquidity tap is potentially useful, and that stabilized things in the short term at least, said Guillaume Palliet, multi-asset portfolio manager at Aviva. It's potentially a more stable environment because it feels like we've passed the crisis point and things should normalize a bit. Well, we'll see about that because I think there are more cracks appearing. Elsewhere, the University of Michigan's preliminary March reading on the overall index of consumer sentiment came in at 63.4. That's down from 67 in the prior month. Economists polled by Reuters have forecast a preliminary reading of 67, but households expect inflation to subside over the next 12 months and beyond. As the economy slows and inflation remains a headwind, consumers are showing signs of retreating under the pressure. Inflation expectations are falling, given the Fed has some flexibility in the future path of rate hikes, said Jeffrey Roach, the chief economist at LPL Financial. Manufacturing continues to struggle, though, under the weight of higher borrowing costs. Spot gold prices rose 3.01% to $1,976 an ounce after touching their highest since April, and US gold futures gained 3.6% to around $1,993 for the week, while the benchmark's S&P 500 ended higher than last Friday's close. The Nasdaq and the Dow posted weekly declines. The risk-off sentiment also hit oil prices. At the session lows, both benchmarks were down more than $3. Brent crude, the global benchmark, fell by nearly 12% on the week. That's the biggest weekly fall since December. US futures fell 13% since Friday's close. That's the biggest since April. The crisis in US banking isn't abating, and it's dragging oil further and further down with it. Crude prices tumbled on Friday for a fourth time in 5 days, finishing with their worst week since the outbreak of the coronavirus pandemic 3 years ago, which practically destroyed demand for oil. The slump this time, however, had little to do with supply demand, but more to do with the crisis in confidence at banks, which provide the liquidity for trading in crude and all other commodities. Persistent interest rate hikes by the Federal Reserve have also led to fears that the US economy could end up in a deep recession. Crude prices remain heavy as banking turmoil won't be going away anytime soon, and over fears that the Fed's rate hiking cycle is starting to take down the economy, said Ed Moyer at Honda. New York traded West Texas Intermediate, or WTI, settled down 2.94% to $66.31 a barrel after a 50-month low of $65.27. For the week, the benchmark was down 13%. It was WTI's worst weekly decline since the back-to-back crash of nearly 20% in the week during the first 2 weeks of April 2020. Near-term technical signals show more weakness for WTI. The volatility could limit the downside too, said Sumil Kumar-Dixit, chief technical strategist at SK Charting. After today's lows, oil bears have $64.62 on their radar, he said. But WTI's consolidation above the 200-week simple moving average of $66.18 could limit losses and start a short-term rebound towards the resistance zone, which begins with around $71.40 initially. London traded Brent settled down 2.99% to $72.48. The global crude benchmark earlier plumbed to a session low of $71.44 and was down more than 13% on the week. Moyer said energy traders are not sure what could be a catalyst to raise oil prices given all the doom and gloom happening with short-term crude demand outlooks. Russian oil stockpiles were reported on Friday to be at their highest since April, amid the sanctions imposed on Moscow for its February 21 invasion of Ukraine. It seems that the oil bump that we got earlier in the month from China's reopening was premature, said Moyer. Clearly, China's recovery still needs more support. The Fed's forecast will closely be watched, as that will signal if we are going to see a greater risk of a policy mistake. For now, oil will remain heavy as traders try to figure out what type of recession policymakers will trigger in the US. European shares erased early gains and had their steepest weekly drop in 5 months, with the pan-European stock 600 finishing down 1.3%, and it was under pressure from banks, insurance and financial services stocks. Germany's 10-year government bond yield dropped to 2.1070. That's the lowest since the start of February, late in the session. Of course, the ECB raised rates 50 basis points on Thursday, sticking to its pledge to fight inflation, even as some investors called for a pause in the rate hiking cycle until the banking turmoil eases, which suggests that policymakers remain confident that the region's banking sector will be able to cope with more monetary tightening even in these troubled times. Worth noting that, relating to the Fed decision, of course, next week. European Central Bank supervisors don't expect contagion for Eurozone banks from the market turmoil. And it's also very interesting to see that the DAX index in Germany traded down 1.33%. The CAC 40 in France did 1.43%, 6,925. And the FTSE dropped 1.01% in London to 7,335. So higher interest rates are still haunting the halls. Late on Wednesday, the troubled European bank Credit Suisse received a financial lifeline from the Swiss National Bank. But now UBS Group is in discussions to take over all or part of Credit Suisse. according to a report from the Financial Times, after an emergency funding lifeline offered only temporary relief to Credit Suisse, and its shares took another beating on Friday. The boards of Switzerland's two biggest lenders are set to meet separately over the weekend to discuss a deal, the FT said, citing multiple people briefed on the talks. Credit Suisse shares jumped 9% in aftermarket trading following the FT report. In the latest sign of its mounting troubles, at least four major banks, including Société Générale and Deutsche Bank, have put restrictions on their trades involving the Swiss lender or its securities. Credit Suisse is a very special case, said Frédéric Carrier, head of investment strategy at RBC Wealth Management. The Swiss central bank stepping in was a necessary step to calm the flames, but it might not be sufficient to restore confidence in Credit Suisse, so there's talk about more measures. The frantic efforts to shore up Credit Suisse comes as policymakers, including the European Central Bank and US President Joe Biden, have sought to reassure investors and depositors that the global banking system is safe, but fears of broader troubles in the sector do persist. Shares in Switzerland's second largest bank closed down 8% on Friday, with Morningstar Direct saying Credit Suisse had seen more than $450 million in net outflows from its US and European managed funds from March the 13th to the 15th. With investor confidence far from restored, analysts, investors and bankers think the loan facility from the Swiss Central Bank only bought it some time to work out what to do next. The move made it the first major global bank to take up an emergency lifeline since the 2008 financial crisis. Authorities have repeatedly tried to emphasize that the current turmoil is different from the global financial crisis 15 years ago, as banks are better capitalized and funds more easily available, but their assurances have often fallen on deaf ears, and of course it's all about pumping in more liquidity from central banks, which won't help inflation one iota. In an unusual move, the ECB held an ad hoc supervisory board meeting, second this week, to discuss the stresses and volatility in the banking sector. The supervisors were told deposits were stable across the Eurozone and exposure to Credit Suisse was immaterial. Asian stock markets rose on Friday, recovering from a series of sharp losses this week as government and institutional support to stem a potential banking crisis did help to improve sentiment, while traders also priced in a less hawkish Federal Reserve. Chinese exchanges were the best performers for the day, with the Shanghai Composite up 0.73%. The index was net up across the week after Goldman Sachs hiked its Chinese GDP outlook for the year, boosting optimism over an economic recovery in the country. Hong Kong's Hang Seng Index jumped 1.64%, driven largely by gains in technology stocks. Internet search engine Baidu rallied over 15% after it unveiled an artificial intelligence-powered chatbot, Unibot. And Pork's telecom conglomerate CK Hutchison Holdings rose 2% after it logged a nearly 10% rise in its 2022 net profit. Other technology-heavy indices also rose on Friday, with the Taiwan Weighted Index and South Korea's Kospi both going up. Japan's Nikkei 225 rose 1.2%, recouping some earlier losses, but the index was down around 3% this week as major financial stocks were sold off heavily on concerns over their exposure to US bonds. And India's Nifty 50 rose about 0.5% on Friday and was set to lose about 3% over the week. In Australia, Australia's ASX 200 index rose 0.42% to finish the day at 6,993, although bigger gains were held back by concerns over rising interest rates in the country. The Australian share market closed firmer, buoyed by the energy sector. The big four banks also ended the day in positive territory. The energy sector was best performing, up 1.9%, with Liontown Resources surging 8.2% to $1.65, and Paladin Energy's shares up 6.9% to 62 cents. The worst performing sector, though, was the REITs, which fell 1.4%. Kelsian Group shares tumbled 7.4% to $5.80 per share, and Evolution Mining shares dropped 5.2% to $2.58. BHP shares closed the day unchanged at $43.19. The big four banks were all in the green, with Commonwealth Bank up 1.21% to 96.45, National Australia Bank up 1.7% to 28.23, ANZ up 0.4% to 22.80, and Westpac up 0.2% to $21.24. Tyro Payments rose 0.7% to $1.46. It comes as shareholders failed to get the fintech's board to reveal both their assessment of fair value for any future takeover offer and the thinking behind their processes as suitor Potentia Capital completes its due diligence. Locally listed recycling company Close the Loop shares rose 21.2% to 40 cents per share as the business confirmed that it will acquire US electronics business ISP Tech Services. The company said it entered into an agreement to acquire ISP Tech Services LLC and Captive Trade, a trading platform, for a total consideration of around $66 million. Link Administration shares gained 3% to $2.08 a share, and the company said it had entered into an agreement with LC Financial Holdings to sell its banking and credit management division for €30 million. Shares in tracking software company Life360 rose 2.3% to $4.95. Life360 said its revenue more than doubled to $228 million in its unaudited 2022 financial year results. Iron ore futures traded higher on the Singapore exchange, firming 0.6% to $130.67 a tonne on the March contract. And data provided by Morningstar shows that more than 60 Australian domiciled equity funds held shares in SVB ahead of its demise, which has sent shockwaves through the global financial system. Mirova Global Sustainability Equity topped the list with a 2.7% weighting in SVB. The fund's latest US portfolio commentary showed it added to its position in the months before the collapse wiped 60% of SVB's value in a single day. At the time, Mirova said a substantial share price decline in the fourth quarter due to deposit-based pressure presented an attractive opportunity. We added to the position at what we consider a compelling valuation and took advantage of what we see as a disconnect between the short-term macroeconomic impacts on the company's fundamentals and the very much more intact long-term value in the company. The fund said, back in December. Franklin Global Growth was also caught on the wrong side of the collapse, holding 2.2% of the $1.1 billion fund in SVB. Portfolio manager Francine Mu similarly noted the stock's fourth quarter decline and growing concerns around increased funding costs in a fund update. However, she went on to affirm her belief in the company, saying, over the long term, we still believe that they have a very strong franchise in the West Coast in terms of Silicon Valley. The Silicon Valley and banking tech companies, as well as healthcare companies. Also among the top 10 funds exposed to SVB are Trillium Global Sustainable Opportunities at 1.7%, Fisher Investments Global Small Cap at 1.5%, Milford Global Growth at 1.5%, and Artesian Global Discovery at 1.1%, according to Morningstar. And Bitcoin also rallied in safe haven buying, hitting a 9-month high of 27,480 US as the impact of the ongoing United States banking crisis plays out. The Federal Reserve injected $300 billion into the economy. A broad rally in crypto markets means Bitcoin is back challenging the week's highs, which also marked its best performance since June 2022. So the question is, can bulls sustain the momentum? Well, nerves are palpable everywhere as the latest economic data shows the extent to which the Fed has gone to contain a banking crisis, which some argue is unlike any other. In mid-mornings that more banks could fall in the coming weeks and contagion spreads to Europe, it appears that crypto could be one of the very few safe havens from the kind of turmoil reminiscent of the global financial crisis back in 2008. Unsurprisingly, reactions are heralding the end of quantitative tightening, the process of removing liquidity from the economy, and a return to its opposite, quantitative easing, QE. Such a policy was enacted previously by the Fed during the global financial crisis, as well as in March 2020 during the COVID-19 cross-market crash. The years that followed saw the US M2 money supply grow 46% before QT began, and Bitcoin went from under $4,000 to nearly $70,000. Last week, the Fed's balance sheet swelled by $300 billion, wiping out 4 months of QT in 1 week, Goldbug Peter Schiff wrote in a Twitter reaction. By the end of the month, the balance sheet could reach a new high. Rate hikes don't matter. Inflation is headed much higher. thanks to bank bailouts. The more liquidity pumped into the global economy by central banks, the better, of course, for Bitcoin, because Bitcoin price volatility may still be rampant, but the message from crypto bulls is increasingly clear. They're determined to ditch the past 18 months downtrend. Well, good luck with that, because there is more trouble ahead. Don't think that all the other banks around the world are doing fine. The point is this. The significant turnaround from central banks and lifting interest rates is having significant pressure on banks and their ability to manage their financials effectively. We're going to see more issues ahead. We're going to see more bank bailouts. We're going to see more downside risk to the markets in the next few weeks and months. And it's worth remembering that, of course, the global financial crisis took 2 or 3 years to really work through. We are in the foothills, but I don't think this is just a small problem, a little local difficulty. I think this is more structural and systemic, and therefore it bodes everyone to be cautious and careful, and specifically, don't be fooled by the bulls out there who keep saying there's great opportunity. Sometimes standing back and watching is the best strategy. Martin North from Digital Finance Analytics. Many thanks for watching. And my next market review in a couple of weeks' time will be from the other side of the world. So I'll see you then.